A lot of growth stocks have had a very rough start to 2022, and Pinterest is no exception. The social network company also struggled to maintain its rich valuation in 2021, falling 55% in the last 365 days and 62% from its high back in April. Now, this is no small drop in value. It makes it a completely different kind of investment opportunity from when I last looked at the business in 2021. And as the ticker's valuation graph shows us here, they got to around 45 times gross profit in 2021, at the start of 2021, which is an extremely high valuation, even for a business that has very good unit economics like Pinterest. It's down now to a single-digit multiple of gross profit, EV to gross profit, 9.5 times to be exact, which I feel actually is quite reasonable at first glance. And apart from when everything collapsed in 2020 due to COVID, it is the cheapest that it's ever been since going public. And we're going to get into the financials and what makes up the valuation later in the video. But first, I think we better address the concerns that investors have, or the market obviously have, with Pinterest and why we've seen this valuation go from 45 times gross profit, which reflects a sustained hyper growth company, and now why we're discounting for slower steady growth at around 9 times gross profit. And the first thing that we need to understand is that Pinterest is a content-driven social network, similar to an Instagram or YouTube. However, it's aimed at less social interaction, and its target user audience is mainly creative people or people looking for visual inspiration for different ideas or events in their life. As an example, my girlfriend was on Pinterest all the time when we moved house and was renovating it, but spent obviously less time on it once that period of our lives was over. So it's seasonal to individual users unless they are full-time creative audience, and more or less people will be using Pinterest for idea generation in specific events and periods in their life. But what they do share with the larger social networks is the two key variables that drive business performance. Obviously, a lot of things that go into these variables, but the two key variables that drive business results over time because of the nature of the business and help indicate the long-term prospects of the network. Those two variables are monthly active users or annual active users, depending on which way you phrase it, and average revenue per user. As you can imagine, almost all of Pinterest revenues come from advertising and promotions for products or similar products that appear on their platform. So average revenue per user is driven by the monetization of users through ads. Now, when these two variables, which are like twin engines, are both growing at a fast pace, it produces amazing results, the kind of results that can lead to hyper growth. But eventually the platform will reach a point of maturity, and the first variable that begins to slow is ordinarily active users, as this is primarily the first step in building up the value of the network, and the monetization of users comes once people form an attachment to the platform. And so as of the latest report from Pinterest, as you can see here, monthly active users have not just showed signs of slowing, but they've actually declined quarter on quarter. This, of course, freaks investors, as it's a sign that growth could slow, and they have to then be relying on the monetization of those users and increasing the monetization, pumping more ads, and that's a dangerous position to be in. However, I think the market and investors have a tendency to overreact in these situations. After all, slowing growth in monthly active users isn't alien to all big social networks. It has happened with the likes of Snapchat and Twitter previously back in 2018 and 2019, and even to a lesser extent with Twitter today. They put out a warning in their results that user growth could slow. Facebook's most recent quarter showed signs of monthly active user growth slowing as well. And I think generally for Pinterest, the spike in 2020, we'll get the graph up, but the spike in 2020 monthly active users due to COVID probably caused a skew in the numbers. It could quite well be the case that some new users tried Pinterest in 2020 as they were at home and internet browsing was at an all-time high, and they decided, personally, I don't get much value out of the platform, and that's fine. It's okay for that to happen on a one-off basis. It's still a platform that's in its very early stages of value creation, in my opinion, and is somewhat of a niche. Like we say, it's not a day-to-day app for everyone. And if we just adjust for that spike in monthly active users due to COVID, we can see that actually monthly active users are about where you would expect them to be if you followed the pre-COVID growth trend line. And so I don't have a hypothesis, at least yet, for why monthly active users are going to get back on track and growing at their pre-COVID rate, but I'm just suggesting to you to look at the situation a bit more objectively than the market is. Of course, momentum is a real thing when growth and decline is in effect, but a lot of the time, if you peel back the layers, there are valid reasons for what's happening, and those trends can be reversed. However, coming away from the growth of the platform, 450 million users is still a massive base to monetize from and build revenue from. There isn't that many businesses in the world that have 450 million monthly users. So there is still a key driver for Pinterest to generate a lot of value. And that, of course, is through the monetization of those users. And actually, this gets us onto a topic where I think Pinterest is sometimes a bit misunderstood and its potential is understated. And that's because it is a visual content platform where people come for inspiration on purchases. So it has that e-commerce edge to it already. And the saying that a picture is worth 1,000 words is actually thrown about by the founder quite a lot. And I agree. I quite like that term in terms of we're talking about the engagement of people on the platform. And although I think Pinterest operates in more of a niche, that should yield better monetization metrics over time for that user base that they have, as the engagement is higher, like I say, and the majority of users are going on there with the intent of finding something, whereas people, just scroll through Instagram and Facebook just to see what other people are doing. And if we're talking about comparable companies from a monetization perspective, Facebook's average revenue per user is around $31. TikTok is around $46. YouTube is around $9. LinkedIn is $25. And even Twitter, which is criticized for having a poor monetization rate, is around $10 average revenue per user, all of which are global network sites like Pinterest. So I'd argue that Pinterest, with its $3 average revenue per user, has a long runway to grow monetization of users. Now, if we look at the breakdown of average revenue per user, it's no surprise that US is the driver of monetization at the moment. The average revenue per user for the US is actually wrong here in terms of an annual average revenue per user. This is a quarterly average revenue per user of $5.55. Annualized, I think it's in the $25 range. I'll have to check that. But the international average revenue per user is far below that, although it's growing a lot quicker. And the main reason for that is, yes, US users are of more value to advertisers just because of the higher purchasing power, but mainly due to the fact that the digital ads market in the US is much more mature than it is internationally. And being specific to Pinterest, they focused their early monetization efforts in the US. So they haven't really been focused on building out the monetization of the international base yet, although that is where 80% of their users come from. So there is a long runway there if they can get that global average up from where it is today. And if we look for reference, Facebook, which along with Google is pretty much the benchmark for monetization through digital ads in this space, has roughly 89% of its users outside the US, and then 50% of those users contribute to the revenue. And over 50% of its revenue contributed by that 89%. In contrast, Pinterest currently has 80% of its users outside the US, but only 20% revenue contribution from that 80%. So the point is that international users can be monetized just as effectively as the US users for these platforms. It's just a case of value creation for the users and the advertisers, specifically in that region. And so now we've covered the sell-off situation and potential concerns for investors in Pinterest, I want to revisit the numbers and do some hypothetical analysis to see if Pinterest really has gotten cheap and warrants a deeper dive. So the first thing I'm going to look at is if we come up with what I think's a fair estimate for average revenue per user growth globally and average monthly active user growth globally, then we can see what sort of revenue might be possible 5 years down the line for Pinterest based off of those two key variables and the assumptions that we make. And like I say, this is all hypothetical at this point, but if we use the current growth rate, what we know about the power and engagement of the platform, as well as comparable companies' average revenue per users that we just looked at, that should allow us to sense check our numbers. And so I've gone with some pretty conservative numbers here. I think 15% average revenue per user increase for the next 5 years. That gets us from around $5.40 today in 2021, which is the current estimate, to around $13.50 in 2026. This is globally and will be driven by 5% increase in the US monetization rates and 45% increase in the international monetization rates, which might seem high, but remember, monetization is growing at around 85% internationally at the moment from a really small base. So we sense check that against where some comparable companies are today. Facebook, Google, TikTok, LinkedIn all average around $25 to $30. So we're saying it might take them 5 years to get even half of that. So I think it's conservative enough on that end. Monthly active users, we're only putting in 5% growth year on year. The pre-COVID growth rate was more in the region of 15%, but I'm going with 5%. I do think as this is more of a niche, we're not going to see it be a billion user platform. I don't think it has that volume potential. However, I do think it can grow from here 5% as it builds and expands internationally. And so that gives us an estimated or potential revenue in 2026, 5 years from now, of $7.74 billion, roughly a 25% compound annual growth rate over the next 5 years. Now let's look at the economics of the business and get an idea of maybe where margins are heading as well. And as Ticker is showing us here, you can see that gross margins have been expanding since 2017 at a very good rate. Started at 62% back in 2017. We're now at actually higher than that, nearly 80% gross margins as of the last 12 months. And this makes complete sense. If you think about the business and what it is, every incremental dollar of revenue earned from the increased monetization of the same user base essentially comes at no additional cost. So if our assumption is that the majority of value is going to come from increased monetization through ads, we can expect gross margins to stay around 80% or even expand a little bit further from that. Now, on the bottom line, it's probably best if I go back to the presentation, but you can see that the majority of gross profit dollars is spent on either R&D or on sales and marketing. It was actually more R&D than sales and marketing before 2021, but they've obviously ramped up that sales and marketing spend to try and acquire more new users. But with the majority of gross profit dollars going on R&D, that tells us that they're spending most of their money on improving the platform for users, merchants, and advertisers and developing new product. G&A, which is really the cost that does nothing for investing back into the business, although it does pay your employees, is relatively small at only 8% of revenues, which is great. And when we look at the cost structure, we can see the signs of operating leverage as gross profit is growing in excess of 50%, but operating costs are more like 20 to 25% if we average these three operating costs here, not accounting for the fact that most of these operating costs are reinvestments to improve the business. And so based on all we've looked at here, I've updated my model on Pinterest, and this should give us a good idea of the potential investment opportunity at large. As you can see, they were very profitable in 2021 or this trailing 12 months, 632 million of free cash flow, which is around a 26% free cash flow margin, which is very good, I must admit. But we should factor in the stock-based compensation was around 362 million for the year, which is roughly 2% of the market cap. And although stock-based compensation isn't cash paid out by the company, it is a real expense for shareholders. Essentially, shareholders foot the bill. And so what I've done to highlight that potential hazard is grow shares outstanding, essentially diluting us by 2% each year up until 2026 to just cover us for that potential investment risk. And so pulling forward our hypothetical estimates that we looked at just a minute ago, I've got 25% compound annual growth rate for the next 5 years. It's probably going to be a bit different than that year on year, but averages out around 25% based on the variables. And then 25% free cash flow margin, we're just going to keep it at that. It's already at 25%. I think that estimate is probably too low, if I'm being honest, but we're being conservative here. And with an exit multiple or assumed exit multiple of 25 times free cash flow, we get to a market cap in 2026 of around 50 billion or 49.2 billion to be exact. And if we discount that back at my hurdle rate of return of 15%, that indicates that a good price to buy Pinterest today is around $37 per share, meaning it's selling at a 26% discount at the moment based on those estimates. Now, all of that does seem very compelling, I must admit. I like the fact that we're using quite conservative assumptions here. and that the business is clearly a good business already, is profitable, and it's just a case of probably the market overreacting to the data that they've seen, the user data that is. And I'll definitely need to do more work on Pinterest to have a clear idea whether these forecasts are realistic or as conservative as I say, and I probably will be doing that. But if you're interested in a deeper dive, then let me know. I'll probably add it to the list of deep dives that are going out on the Patreon this quarter. But thank you all for watching. I'd appreciate if you could leave a like on the video if you enjoyed it and comment with your thoughts. I will leave a link to the Patreon below if any of you are interested in more research, analysis, deep dives, and investing content that doesn't reach the channel, as well as our Discord investing community. But until next time, good luck with all of your investments. Bye-bye.